Welcome back to another episode of the Startup Therapy Podcast. This is Ryan Rutan, joined as ever by my partner, friend, and CEO of Startups.com, Wil Schroeder. Wil, today I want to talk about how often we've had to say no or decided to say no. I think a lot of people look at what we've built with Startups.com and think, man, these guys hit $100 million valuation within a couple of years. They were acquiring companies left and right. And I think there's this sense that we were just running around saying yes to everything and kind of grabbing and growing as fast as we could. And you and I both know that's actually about as far from the truth as it could get.
Little did you know how often we were saying no.
Yes.
Okay. So the other side of it, we were bootstrapping, right? So you don't have any choice. So I think a lot of folks that are probably listening to this, even if they've raised money, I think in this episode, it would be really interesting if we talk about why we were so adamant about saying no, kind of what no bought us, and also to some degree what no cost us. It wasn't all good decisions. But we built an 8-figure business in a fairly short period of time with no outside capital. A lot of people ask us how we did it, right? And again, if I were to summarize down to one word that isn't no, I would say discipline. Which to be fair, Ryan, earlier in my career, I didn't have. Like, I couldn't have pulled this off, right? I didn't understand the value of saying no. Because I thought yes was the only way you get ahead. Then you make all these mistakes, and then you're like, oh shit, okay, I get it now. Being able to say no is actually an incredible discipline that very few people have.
It's a discipline. I'd also argue that it's a luxury. There are times where you want to be able to say no. I think that there's definitely a misconception that having to say no means not being able to take opportunities, not being able to do the things you want, and sometimes it's just not the case, right? Interestingly enough, and as you mentioned, we bootstrapped. I would say that one of the major things that happens when you do take on funding is you lose the ability to say no. You start to have to say yes. You don't have that choice anymore. The optionality goes away. You have to start to say yes to everything because you got to grow and you got to return that investment, right?
Yeah.
So I think it's discipline. On one hand, there were periods where we had to be extremely disciplined to make this work, and that did mean saying no to things. But I also think that at this point, I treat the ability to say no as much of a luxury as I do a discipline.
And think about it. In the formative stages, when we're building a startup, we want to say yes to everything, right? We want to hire more people. We want to maybe do an acquisition. We want to increase the marketing budget. Like, it seems silly to say no as a discipline, right? Again, to your point, in the formative stages, it feels like we're saying no because we have no choice, right? Oh, we don't have enough capital. So that's always the answer. And the truth is, being able to step back and say, look, I've seen this story play out enough times. Just saying yes to everything without giving things a little bit of time is a dangerous play. And honestly, it doesn't end well. And if you haven't done it before, you don't know that, right? You're going, well, if I don't say yes to everything, then I'm choking the business, that I'm not growing, that I'm less of an entrepreneur. It's kind of bullshit. And so what I'd like to do, if you're cool with it, I'd like to maybe kind of dissect this a bit and talk about where we say no, why we say no, and what it buys us, and again, sometimes what it costs us.
Yeah.
And I would say, and I think you'd probably agree with this, the first thing it took us a long time to understand is that this is all going to take time.
Yeah. Well, it's interesting, but I think that is one of the, when we talk about the cost of saying no, that's the very obvious one. It's the one. So saying no doesn't mean never. It means no right now. And typically what you're talking about is not so binary, right? It's that it's not going to happen now. We're going to have to say no for now. And it's going to make things take longer, right? As you just said. And that's not really as much of a problem as we would like to make it, right? This influenced urgency, self-imposed urgency that we put on ourselves is really a big part of the problem. And it's part of what makes saying no more painful than it should be. Because we feel like, if I say no to that hire, we're not going to be able to open that new marketing channel and the business isn't going to grow. Well, that's not necessarily true. It might not grow as fast, but Yeah. So I think that the timing aspect of saying no is probably one of the most critical. It's one of the most obvious. In terms of the actual impact, I don't know that at the time you're making the decision, because as I go back and I think about times that I had to say no, sometimes they felt extremely painful at the time. Um, and I wasn't really giving enough weight to the fact that all I really was saying no to was no right now, right? And that decision will likely be there again later.
Right. You're saying no to win.
Yeah, exactly.
There's always this assumption that when the opportunity is presented to make a hire, to increase marketing, to do whatever we think we're going to do, that if we don't do it at that point, that there's automatically opportunity lost. That
Yes.
there's no other way around it. We don't stop to think, maybe by saying no, I'm also going to create opportunity by not spending money at the wrong time because I don't
Right.
have the entire data set yet. And I think probably the the best illustration of this that we can talk about in detail firsthand is when we launched one of our first products, Fundable, back in 2012.
Yes.
Ryan, if you were to set us up here, what was the state of crowdfunding circa 2012?
You ever see those videos where, like the old clips of people going to Beatles concerts?
Right.
I think that was the level of excitement around crowdfunding. People were literally fainting and swooning. There was a lot of anticipation. There was a lot of excitement around it. As we know, that the reality has proved out very, very differently. But if you had simply looked at it at that point in time and said, man, this just has to be amazing. Like, this is going to blow up. This is going to be the biggest thing ever.
Right.
And of course, you're building a business. You always want those things to be true. So there's some selection bias there. Luckily, we didn't really fall into that, because had we started to make decisions about the business based on what we saw in 2012, we would probably be part of the now expanding. I'm not even sure you can still get a grave site in the crowdfunding platform graveyard, right?
Well, okay, so let me build on that a little bit. And everyone listening to this, saw crowdfunding kind of evolve, but not a lot of people understand what really happened to it.
Yeah.
The short version is nothing. The bet back in 2012 was that crowdfunding was going to replace, equity funding. It was going to replace how companies got funded. And to be fair, ideas did get funded. It did not work. It just didn't work at the level everybody thought it would.
It didn't create new capital. Yeah.
Yeah. And my dates are off a little bit here, but it doesn't really matter. Circa 2012, the big deal was that Pebble Watch raised $1 million on Kickstarter. And that was the impetus where just people went batshit, right?
Yeah.
And every single person was starting a crowdfunding for something, right? Everybody had a take on it. And everybody was super pumped. A lot of people raised a lot of money. And we've talked about this a little bit in previous episodes, but this is so much more relevant here. We were looking at it going, maybe?
Yeah.
But we're not quite seeing, like we were kind of in a don't believe the hype moment. And the reason I want to say that is because we get so high on our own supply when we have our startup ideas, right? All of them. We all believe that ours is the one that's going to be the next Uber or the next Airbnb, which is ironic because both of those are getting tanked right now. But the point is, we genuinely believe, and we're kind of supposed to, that our ideas are exactly the right time at the right moment, etc. And that if we don't fully capitalize, we're going to miss the opportunity of a lifetime. And to be fair, sometimes, rarely, that's true.
It can be.
Okay, it can be. Good point. More often than not, though, nothing happens, meaning the market evolves at a rate that's just like any other market, and you build like you're going to build. That's probably 90% of the time what happens, maybe more. Everyone's worried that they're going to miss that 10% or less of opportunities, that window of opportunity. But at the time, even though everything was going gangbusters and there wasn't a single market signal that said, don't get on this train, we were looking at it saying, wait a minute. The number of people funding deals doesn't seem to be going up geometrically, and the number of good deals seems to be pretty capped. So if Kickstarter is killing it, how long before they run out of Pebble watches, right? Just have all the perfect storm of opportunities. And on the funding side, more so in equity, that's the business we were in, but also on the reward side, we're like, there is kind of a limit of share of wallet of the number of people that are willing to fund those types of projects. and the number of people that are looking to make equity investments at $1,000 or more, whatever the thresholds were. Kind of not, we stepped back a little bit. This goes back to the discipline and said, we believe we want to be in this space because it's developing, but we're not going to push all our chips in. I mean, how did you see it, Ryan?
Yeah, the same way. I mean, there were sort of two big bets on crowdfunding, right? One was that it was going to increase the available capital because now everybody's, rich aunt and uncle were going to come out of the woodwork and start to invest in startup companies. That was one side. The other side was that it would somehow democratize the landscape, and that deals that, because of geography or visibility in some other way, wouldn't get funded, that it would start to level the playing field a bit there. I would say that of those two bets, bet one failed completely, right? We didn't really see more capital coming into the market. I would say that bet two was definitely at least a partial success. We did start to see companies outside of the typical funding centers at least get exposed. Now, maybe then in order to get the funding, they were forced to move to one of those locales, but we did see that second half of it play out. So, as we go back in time then and we think about what we were doing and how we were reacting to that, we did it right. As you said, we maintained our discipline. We decided not to go crazy, not take on funding, not do, any of the other, crazy growth things we could have tried to really to push our position into a market that still was not at all certain. Right. And I think that there's just, if we go back in time, we had a product that we were still trying to figure out and a market that we were still trying to figure out. Right. And I think that was where, this need to let it take time. It wasn't just about our product. If there's a very well-defined market, maybe you can make a little bit better case for urgency and saying like, okay, the market's there, the market's ready. Our product's not. We got to push hard and we got to get in front of people. But we were watching a market take shape, from nothing. Yeah. And it was changing quickly. And so in that case, and we talk about this a lot, acceleration just means going faster. It doesn't necessarily mean going the right direction. Had we decided to accelerate our growth into the crowdfunding space, and it's something I think about a lot, like the other opportunities we would have missed by capitalizing on those opportunities that turned out not to be good opportunities, would have had a major future opportunity cost. We wouldn't have been acquiring companies. We wouldn't have been in a position to remain profitable as we have had we gone all in on some of those early bets around crowdfunding, right? And so letting things take their time allows you to start to see more clearly, is there truly an ROI here? Is there really an opportunity here? And so, I just letting things take time is always going to be good advice. We could probably throw that into every segment that we do, Will, and it would continue to make sense. Like, just slow down a little bit.
In that time, as we were looking at Fundable, we were looking to expand the portfolio to kind of realize the startups.com vision of helping founders. We looked at hundreds of companies to acquire. We did diligence.
Was it only hundreds? Are you sure?
But we did diligence on 40. So, we're pouring through financials on 40. We made offers on 6 and we ended up acquiring 6. However, one of the things along the way that, and I think this will be helpful both to folks looking to sell and buy, or just interested in the acquisition space as a whole. Every time somebody comes to you and says, hey, I have a deal for you, it looks something like this. Here is the best month, quarter, or year that we've ever had, right? And I'm going to annualize that. By the way, if the last 6 months sucked, I'm just going to focus on last year, right? I mean, I get it. I do the same thing. But the point is, every company kind of says, here's us in the best light, right? It's the equivalent of people being like on a Tinder profile, like here's my best photo, right?
Right.
And that's what I'm trying to sell, which is fine. I mean, again, that's sort of what you're supposed to do. However, the one thing we always did, we said, cool, you had an amazing month last month. We're going to come back next month, see how you're looking.
Right.
You know how often the next month happened to be as good or better? Never.
Yeah. Never.
Never. And again, it's a bit of discipline. Ryan, I like the way you said a bit of luxury. To be able to stop and say, let's not get too hung up. Let's take a minute, just kind of hang back and see if this thing comes to us. And comes to us meaning, kind of if it was meant to be, and I don't just mean a karma and destiny here, but I mean, if this company is continuing to trend, then one, it should be there in a month or two.
Yeah. Yeah.
If it's not, then we miss it. Not the end of the world.
Yep.
But if it is, and the trend lines continue, then we're interested. And so I think when we were going through that process, one of the most powerful things we did was exercise discipline over a long period of time to know when it was the right time to finally say yes. Now, did that mean we hit every time? Not really, right? I mean, again, it doesn't mean like you're going to win every time. But here's what I really want to point out. You know how many times we would have lost? So
Yep.
many times.
Yeah.
So many times. And look, it's a little bit different in M&A than it is in VC. In VC, people tend to be fundraising at a specific moment in time, and everyone else that you're competing with for investment is also competing on that week. So you kind of usually don't have the same luxury. M&A is a little bit different, longer timelines, et cetera. But the reality is the same. We never got hung up on the moment. We always let things just take a beat and see if they were still the same decision a week, a month, a year from now. And I got to tell you, that served us incredibly well.
The other thing that's interesting, Will, and I've given this some thought too, if we go back in time, even back when we launched and it was just really fundable, right? And we knew that we wanted to build more of a platform, more of an ecosystem, that funding was not going to be where it started and stopped for us. We had that vision. So what was interesting to me was by having the clear vision of what we wanted to build off into the future, right? Not getting too caught up in the final thing, because we knew that was going to change and we knew it needed to be fungible. But one of the things that was very clear to us, because we had a long-term vision, we knew everything else we wanted to build. Having that clear vision allowed us to balance what we did tactically. And in other words, it gave us a reason to understand the context of the yes or the no, right? So if we said yes to another acquisition in the funding space, it meant we weren't going to be able to get to planning or customer acquisition or education as soon as we wanted to, right? And so it was far clearer to us what the additional costs of saying no were, because we had that vision. And I think that, not our first rodeo, right? We talk about that a lot. So we knew that there needs to be that kind of vision, that North Star, something that you can lean on, even if it's highly theoretical, and it remains highly theoretical. We have a great idea of what we want to build, but we're still very much willing to admit that may change, but we still have that North Star and we can measure things against that. I think one of the things that happens with, early founders, early stage companies, and maybe if it's your first time or you're in a brand new market, you may not have as much clarity of that longer term vision for the company. Sometimes that's almost by, if not directly by choice, it's just by not having put enough time into thinking about the vision of the company. And I think that can lead to some problematic decisions.
Can you illustrate a little bit? Because I think this would be helpful. What our long-term vision is, like, it's actually fairly simple as far as like who we're helping, et cetera.
Yeah, of course. Well, no, I think that's a great point. So if we look at the vision of the company, at a very, very high level, the kind of driving force behind all this is that we know that startups are going to need help starting, founders are going to need help starting their companies forever, right? The context of that help, what actually needs to happen, the tools that are required, the information that's required will change, right? As markets change, as how people start companies change, that's all going to change, right? However, that core piece is still going to be there. It's still going to be hard. People are still going to need help. And so we want to continuously modify what we're doing, continue to build towards those goals and those outcomes, regardless of what they are, right? And so we have that. And so I think the other thing is, because we're admitting that like this whole thing is going to continue to change, but that people are always going to need help, it allows us that freedom and flexibility to say, hey, this is going to take a long time, right? Just by nature of this. And, as long as we can structure ourselves to be around long enough to stay helpful, we're in great shape, right? There's no rush. There's no urgency. So the vision for us is be able to be helpful to founders off into infinity, right?
it also implies that we can miss.
Yeah.
Right? If we miss at one opportunity, at one acquisition or building one product we miss in the market, it doesn't really change the fact that our customers still need this type of help, and there's 50 ways to provide
Yeah.
it, right? And I think that gave us a much better perspective on how to think about decisions, to say, okay, look, even if we launch this thing and we screw up, it's not ideal. I mean, we worked on it for a year and a half, let's say, right? We put a lot of resources into it, but it's okay because the problem still exists. We can take a long view. We can say we're going to be working on this problem for 50 years. We're going to miss along the way. This is just one of those misses. We hope we don't miss, but we will.
Yeah, well, I think it's a great point. I mean, as we think about the decisions that we've had to or been able to defer, and I would still say that some of these were absolute luxuries to be able to say no to at the time. Some felt a little painful, but knowing that we're going to spend a generation or more building this thing out, it's okay to say no. It's okay to defer those decisions. It's okay to say, yeah, we'd love to have that developer right now. We can't necessarily fit that into the staffing line right now. And that's okay, right? We will at some point be able to. By knowing that it's going to take a long time, admitting that, and taking away that urgency around this need to scale quickly, or need to scale at all, right? There are times where you may say, like, look, we're good right now. We actually don't need to get any bigger. Let's spend a little more time on being a little better, or building out something new that doesn't necessarily lead to immediate scale. That's also okay, right? And we've done an entire episode on growth for the sake of growth is not necessarily a great idea. And I think this speaks to that, right? I think that there are time and place for growth. There's a time and place for hiring. There's a time and place for risk. There's a time and place for acquisition, for profitability. And I think that's something we should talk a lot about today, Will, in terms of our decision, because this is another one of those kind of North Stars around profitability and how many things that actually led us saying no to, not yes to, because I think a lot of people think that, it takes a bunch of yeses to get to profitability. I would say in our case, there were actually far more no's involved in the equation that we balanced out to get profitable.
I don't think people understand like how disciplined we are about our income statement, right? I mean, so folks that are listening can know, and I'm our CFO, so I can I can say this directly. We've used our income statement the way people use project management boards, like a Kanban or anything else like that. Like our income statement is this single most understood document in our entire company across every level. And when I say that, not 100% of people have access to the income statement, mostly managers, decision makers, and leadership. But those that do understand it down to the penny. I'm talking every single line item across our entire P&L. We've got 200 people across every staffing line, down to like if our we've got a column for miscellaneous stuff. If we have a weird $1,000 miscellaneous item, everyone within 24 hours is like, what just happened there? Right? And it's not a fairly sizable business. So, it's not a small business. But what I will say is that discipline, and more so that focus in saying, if it doesn't make sense in the income statement, we can't say yes to it. And getting everybody to start to understand that has been like kind of one of our secret weapons. And because most startups don't understand finance to begin with, it's typically not something they use as a weapon. But here's where it gets really interesting, Ryan. If you give me like just a minute here, I'll try to illustrate how that understanding translates into saying no, but also saying yes.
I'm just going to drink some coffee. You go for it.
I've had it. You're like, yeah, I've never heard this before. What it comes down to is by having an intimate knowledge of our income statement. And what I mean by that is like we update it daily. We're so close to it.
It's literally, you can see, it's funny, but like when you open it up and you can see the other viewers, it's like every morning everybody opens it, right? We're all in there and everybody always has it open. It's incredible.
Absolutely. And here's the funny thing. It actually doesn't even change that much. I mean, our business is so incredibly consistent. But we can also, and this is pretty awesome, and we've always been able to do this over 8 years, we can predict our net income and our gross income within like 2 percentage points every month.
Yep.
And that has more to do with how tight we are at forecasting and focusing on our dollars. But what that really means and how it's relevant to this discussion is we can make lots of decisions, yes or no, almost immediately because we know exactly how that's going to impact all the other lines of business. If someone says, hey, we need another developer on the staff, we know exactly down to the penny how that would impact marketing, how that would impact finance, how that would impact other staffing decisions. And we all know the answer is no,
Yeah.
right? Or yes in some cases, but nobody has to guess because we're so well attuned. Well, what that did early in the early days, when we were still, kind of bootstrapping and figuring things out, is it allowed us to take basically all of our company priorities, all the stuff that you want to do. I want, again, hire developers, increase marketing budget, et cetera, and have everybody who runs those different functions be able to understand intimately how their decisions or how what they want would or would not drive the P&L, which would or would not drive a yes.
Yeah.
So, Ryan, if you said, hey, I want to spend more, Ryan's also our CMO. If you want to spend more on marketing, you would look at that and say, yeah, but I really want a developer because I have this, marketing related tech that needs to get done. So I'd really like to see that decision happen first. But down to the dollar what that decision is.
Yeah. I think it's interesting because what it essentially does, right? Because as you get into the nuance of each department, the language and the context can be very difficult to translate from department to department. The beauty of using the income statement is that, like most math, it's a universal language. And so it allows us to quickly translate needs, wants from one department into impact to the others, as you said. And the other thing that you brought up was that not everybody has this level of visibility into the actual income statement. However, we do talk about the pieces that are relevant to the individuals in any given discussion, right? If we're going to lean on
we compartmentalize
finance, right, we definitely bring up the moving parts. They have visibility enough. They have the context to understand. It's not we just don't have enough money for this, or we don't want to spend that, or we need to spend somewhere else. We're able to give them enough context that they can truly understand the decisions and also understand what other factors would need to become true in order to get to yes. And I think that's the other piece that's so important here is that when you say no, being able to condition that with here's how and when and why we would be able to say yes also makes those decisions a lot easier because they at least feel better, right? I no longer have to just simply say no. I can say no, here's why, and here's what we could do to change that answer in the future, right? If this still is a need, here's what would have to occur to make yes the right answer. And so you're not just sending people off with a no, or we're not just having to say no and then compartmentalize that. We're able to say no, but, and then we can move forward and say, if this matters enough to me, I will go make the conditions for yes true, and then we'll move forward, right? And I think that has a lot to do with not only the discipline piece of it and being able to understand why and when to be disciplined and when we can say yes. But it also has a lot to do with then being able to achieve those things and actually move forward and get to yes.
Well, yeah. And what's really interesting, you said it's universal. It's kind of this simple. If you're thinking about making a decision, plug that decision into the P&L. And if the number at the bottom is positive, then it might be yes. But if it's negative, then it's definitely no.
Right.
We kid around like this is like we're saying something so obvious, but we work with enough startups, Ryan. This isn't universally obvious, right? Often the CEO doesn't even know whether those decisions are going to lead to a positive or negative number, especially if you push them out a few months. But where it's been really powerful for us is it also says so long as we stay essentially on the right side of profitability, we have full agency to do whatever we want to do, make acquisitions, etc. But the moment that puts us in the red, which is too close to not profitability, or anywhere in the red, that is red alert. Right? That is everyone has to stop, drop everything, and say fix that. Can you imagine if more startups had that level of discipline? If profitability was so incredibly tuned into everything that they're doing, and Ryan, I'm not knocking startups that don't do that because again, there's a million use cases that I would support where losing money to make money later is the right gamble. It's kind of what VC is about, et cetera. But most of what I see isn't that. Most of what I see is just poor cash management.
The results speak to it, I would say, right? Like the outcomes in real life tell us that that's also not optimal.
Yeah, when I think the other side is, it's a lack of financial understanding, which is all part of this discipline. We can have this discipline because we made the universal understanding across our company understood by everybody, right? Whether it's dev team, marketing, et cetera, like everyone gets it and everyone has an intimate knowledge. So they understand exactly how to operate.
Yep.
When new folks plug in, they can look at that and go, oh, I get your formula now. If it's profitable, it's a discussion.
Yeah.
If it's not, it's not.
We don't have to get into the nuance, right? We don't have to get into the nuance of whether or not this is something that should happen. If it won't work financially from the beginning, we don't even have to get into the nuance of whether or not this is exactly the right decision. It allows us to kind of quickly eliminate a lot of things that I think other companies would then struggle with or drag out the decision and spend a lot more time on the consideration piece than is necessary, because we developed. I mean, it didn't happen easily. It took time to get there, but now finance truly is the kind of the lingua franca of our business, and it allows us to have this framework for decision making.
And it's also, I mean, for what it's worth, it's allowed us to outlast almost all of our competitors.
Yeah.
I mean, even if you're $1 profitable, you can live to fight another day. But if you're $1 negative, you're eventually going to die. And so we looked at the discipline of profitability and the ability to say no that anything that would impact profitability as the unquestionable factor. And I have to say, if we look back at our history and all the decisions we didn't make, again, because often the profitability was the issue, I don't regret a single no decision that we made. I regret some yes decisions, but not a lot of. I actually can't think of any.
I mean, it would have been fun to buy Atari, let's be honest, but I'm glad we said no.
we did try to buy Atari. At one point. Long story. It's its own podcast. Kind of hard not to regret that one. But look, given given how many decisions are brought to us, and for those folks listening, I mean, think about it. We've got a platform with over 1 million startups. You know how many startups come to us and want to sell us something?
Yeah.
A lot, and not because we're special, just because we happen to be kind of in the middle of it all.
They have our ear, so they'll ask, right?
And we're so optimistic about startups. That's why we do what we do. So it's really tough for us not to get excited about what they're doing, which is why we always joke that we'd be the worst investors of all time, because we'd want to invest in either everything or nothing. Either everything because we're so optimistic, or nothing because we know better.
Yeah, we get that question. Yeah, what do you think about acquiring us? Yes. What is it that you do? Right? That's the answer, right? And then let's say yes, and then let's go figure it out.
When we look at our ability to grow, when we look at our comfort level, let's say it, Ryan, with saying no is very high. And I think part of that, and I'd be curious your thoughts here, I think part of that is because as a team, as a company, we've had so many reps on saying no and being happy that we did, that saying no feels a lot more comfortable than it used to. Would you agree with that?
I would. I think, again, if we talk about this from a luxury standpoint, we've created the luxury of being around long enough to be able to see how those decisions played out, right? So I think that's something else, like not solely by virtue of saying no, but because we've been disciplined across the board, right? Not just around what we've said no to, what we've said yes to, how we've spent money, what we've decided to do, what we've decided not to do. We have been around long enough to be able to have the hindsight to see the value of those no's, right? And of course, there were things we could have done that may have changed the business a little here or there, may have moved things a little faster. Again, I don't know if that would have mattered much. But I think that by virtue of having been around long enough through this discipline, through saying no to things, we're able to clearly see the value of those no's. Right? And I think that the inverse of that is that you end up saying yes to a lot of things and maybe, getting over your toes, over cash flow, over whatever, right? You run out of room, you run out of runway, you're out of business. There's not enough understanding at that point to be able to see, like, really, where did this go off the rails, right? What should we have said no to? If you didn't say no to anything, you just said yes to everything, still went out of business. How do you do the calculus on that? And so I think that, as we talk about why we chose profitability, it's because it allows us to be around. It guarantees we get to come back tomorrow and the next day and the next week, the next month, the next year, we will be here. And because of that, we're able to see the impact of those. And I think that luxury and that ability has now given us, full great feelings about being able to say no in the future, right? We now have enough evidence that says, yes, sometimes no is absolutely the right decision. And so we don't have to question ourselves each time we do this. We're like, let's use the same framework we've been using. Let's continue to say no where it makes sense, and move on, right? And do we get 100% of the bets right? Of course not. And that doesn't matter, right? We're making enough of the right bets and saying no to enough of the wrong things to have been here long enough to be able to look back at it and say, we did it right? And that feels good.
The way I always tell entrepreneurs to think about these decisions is yes may give you more opportunity, but if no is going, if not saying no is going to tank you, then that's not a good decision.
Yeah, exactly.
In other words, if I say yes to a developer and I might be able to get the product out faster, but that runs the risk of maybe not making payroll anymore and going out of business, then I'd rather say no. I'd rather maybe take more time to get the product out there, but be around long enough to be able to say yes or no in the future.
What's interesting, no has a lot more certainty to it in most cases. I can think of some decisions that don't, but in most cases, no has a more certain immediate impact, right? If I say no to the developer, I save the cash. If I say yes to the developer, I might move the product faster. And when I put the product into the market, it might make us more money, but you're now starting to compound uncertainty, right? It may move faster, it might not. It might work in the market, it might not. We might be more profitable because we might not. But there's definitely certainty around the saving of the money, right? And it's not just about the financial cost, right? There's a lot of things that end up happening when you say yes that can be quite unforeseen, right? There's very few unforeseen circumstances, at least in the kind of the near term, around the nose. And I think so the fact that there's far more certainty there should also give you some comfort in being able to say no and being clear on what the return on investment of that no is.